Meanwhile, China's manufacturing sector contracting for the third straight month as deflation fears rip through the world's second largest economy. Inventory and employment data also declining. For more on China and ongoing trade tensions, let's bring in Riedel Research founder and president David Riedel. David, great to have you with us.
Thank you.
We've gotten a few more economic readings under our belt, so to speak, since the China-U.S. trade war reopened with President Trump. And I'm just wondering, what position is China in now, as opposed to, let's say, even a month ago in these trade negotiations?
You know, they're treading a very fine line. They need to keep their factories busy to keep people employed and keep things, the economic engine running. So they need to create domestic demand that can take up some of the weaker demand from the U.S. in the face of these 55% tariffs, which are clearly unsustainable for all sides. So they're diversifying, sending cheap goods into a bunch of other markets. Germany's been complaining about this, Southeast Asia. You've seen a little bit of UK uptick. And you've seen quite a lot of activity, especially in the auto sector, a lot of demand domestically in China. So they see this, they know it's happening, and they're diversifying pretty quickly in terms of sopping up some of this excess production, given the weak U.S. demand.
David, Tim, always great getting your views on China. I guess I'm kind of bulled up on Macau. I'm long. I'm long Melco and I'm long Las Vegas Sands, and I just feel like this is one of the COVID trades that is yet to come back, and it doesn't really require China stimulus for this. Am I wrong?
That's right. No, I think you're exactly right. Actually, we're bullish on domestic travel as well, which we think is going to be a great beneficiary of Chinese staying home, Beijing playing a little bit of the nationalism card, and people staying home to travel around. So we're looking at H World Group, which is one of the hotel companies, but I could be right alongside you on Macau. I think that Chinese are going to stay home and they're going to spend money at home, both sort of on the business side as well as the travel side.
Dave, Lori Calvasino, one question I've been getting from investors is just exactly how much inventory did companies in the U.S. pull from China? What's your gauge on how long has that been going on? Did it start last summer? Did it start recently? And how much inventory, is your best guess that U.S. companies have to still work through here?
I think you've got about 2 months more of inventory for U.S. companies. I don't think they started as early as last summer. I think some of them wish they had. But I think you're starting to see that run out here towards the end of the summer, and certainly going into that critical holiday season. That's what kind of worries me. I don't think the U.S. consumer is ready for the kind of uptick in prices going into Christmas that are going to be embedded if this 55% tariff stays in place.
David, it's Karen Feinerman. So first of all, thanks for being on. From time to time, we hear stories about delisting of Chinese stocks, and sometimes they feel more relevant or close by. Or what's your current take on whether or not we could see that happen?
If you'd asked me a couple of years ago, I would have said absolutely you're going to see some delisting of U.S. listed Chinese stocks. But it seems like the pressure's off that for now. We could see the current administration make a quick decision to do something on that side, but I just don't see it happening with the kind of pressure or impetus and momentum that we saw a couple of years ago. They solved the issue of the audits with the SEC, and I think that really takes the pressure off. I think China's okay to let those listings not get increased and focus on increased listings in Hong Kong and Shenzhen and Shanghai. But I don't think you're going to see delisting unless the U.S. chooses to do it, which I think would be a terrible idea.
David, in your view at this point, what is China's greatest point of leverage over the United States? I mean, we saw rare earths as one, but then they sort of backed down, and apparently rare earths are now flowing back into the United States.
Right, but only for 6 months and very much on their schedule. Mm-hmm. So I think that remains one of their big points of leverage. The other thing that I think the U.S. is not recognizing is the fact that so many of these supply chains to China diversified during COVID and afterwards. The U.S. was 24% of Chinese exports pre-COVID. It's now about 15%, about the same size as the EU. And they've got a lot of other markets around South Asia and Africa and other places that they've developed for the last 15, 20, 25 years that they're really targeting now with this excess capacity. They've also been very good at developing domestic markets. So I think their ability to absorb a 30% drop in exports to the U.S. by diversifying into domestic as well as other markets that they have supply chains to, I think that's a point of leverage that I don't think the U.S. is fully appreciating. But I think rare earths is going to be back on the table. It's only 6 months, and that's a very, very powerful point of leverage.